Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of orats. Orats is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we'll share the lessons we learned about short put spreads after running millions of backtests on SPY, IWM, and a bunch of other tickers. We'll also go over two active positions that we have on EWJ and IWM. Matt, if you're ready, do you want to share your screen and get us started?
Sure. Thanks, Tyler. So we have an existing trade that's been going on for a while. It started as an iron condor. It moved up towards one of the legs, and then we rolled out the unchallenged leg. So if it rolled up, the puts were getting more and more out of the money. So we closed them for a nice profit, and then we did another put spread. So maybe you could see here, Tyler and gang, the short put spread. The cost was we sold it for 65 cents. We sold the April 70.65, and EWJ has since gone up to 71. It's down a bit today. So we were a little bit better at the beginning of the day, but we're still pretty good. So now it's 63 cents for the April with 26 days left and 15 cents. So we're up about 20 cents on that short put spread for EWJ. Now, we've been teasing our trade journal. So one of the things that we could do is look at the whole history for EWJ. So we put on an iron condor. We put on and got out of this one quickly, but this is the iron condor that we're looking at. And then we rolled out of that, out of the money 65-62 put spread that you see here into the 70-65, and so we still had that going. We were exercised in the call, 57 cents in the money. So that's a loss for that one particular. So that's the outflow. We sold the entire spread for 77 cents. So we're up a bit, so we're up 20 cents in the original, and we're up 20 cents on the short put spread. So that's EWJ that we still have going. That short put spread is still alive. And then we had, from last week, we did a double calendar. So a double calendar. So let's just look at what that looks like from a payoff picture. So we had basically a calendar in the puts and a calendar in the calls. So they're double peaks, and it's kind of gone up towards the call. So that's good. It went in our favor. So you can see that we sold it for 50, or that, excuse me, we purchased two calendars for 54 cents. And now that's up about 20 cents, so 24 cents. So that calendar, you can tell, is going towards this peak here. So that's the 207 peak. So we're in a nice spot for that with the stock, just below 207. 3 days left on the March 27th. So that'll be nice. If that cancels out, then we'll really have a nice a profit there. So how does that look, Tyler, for explaining the trades that we have on?
Yeah, it's good to see we're continuing to make some good trades here. That double calendar is one of your favorite trades. We've made it several times over the course of this show. I think this is our third or fourth double calendar.
And
they've all been doing pretty good.
Yeah. It took me a while to understand the calendars. When I first started market making, one of the people that started with us was making a good amount of money, and he always thought in calendars. I always thought in theoretical values. So it took me a while to figure it out, and now I like calendars now. I wish I would have known that back then.
Yeah. Well, we have several other shows dedicated to the calendar. So if you guys want to learn more about those, we have a few other shows where we dove into those in more detail. But today we're going to look at short put spreads, which are a vertical spread strategy, and we've back tested so many of these and we have a lot to share with you today. So we're excited to get into it.
Yeah, great. So I'll go to the backtester, and we're going to look at SPY and IWM today. We're looking for just these huge backtests that we do and what we've learned from these large backtests. Specifically, what are the best expiration DTE, days to expiration? What are the best deltas? And then as far when is a good time to exit those? So we could rank these on a number of different things. I like to rank based on this is a custom ranking system where we use, the real risk, I think, is your worst month, your worst annual return, and your max drawdown is kind of our denominator. And then, our day by day average is our what we're dividing by the denominator. And so we could see that what comes up then is what we think is the least risky, best return. What I think on risk is measured. So that's what I'm using as a ranking tool. Ascending, of course, we could do descending to see the worst ones, but these are the best ones. And then I've narrowed the days to expiration. I mean, there are some very wide short-term days and some very long-term days, but these are generally the most popular. I put in 15 to 70 days on this short put spread. And then I've also narrowed down the strike deltas to what most people use. So we could look at those. So of those, we see, this is pretty standard. This is what we like to use, 36 days, 33 delta, 15 delta. So you're buying the 15 and selling the 33. Now, what we want to look at is also what are the best times to exit. And then again, this is just for SPY, and we'll look at IWM after this. But this sure looks like they like to get out somewhat quicker from these. 33 delta is pretty close to the money. Here's a 50 delta that's farther out of the money that they don't do anything with. So what I've kind of noticed is the farther out of the money and even longer term, they don't want to do an exit. They want to ride that one all the way. So whereas, when you're seeing like 44.20, you're going to see some pretty tight stops and profits in order to maximize what I think is kind of a conservative way to rank these. Is that okay so far, Tyler?
Yeah, that sounds good. There's a few things we can kind of go over first. I was thinking we could look at the performance metrics and sort of explain what we're looking for in a short put spread. Like, is this a strategy where we're looking for a really high return with high risk, or a relatively low risk strategy? Like, what are you sort of, as a trader, what are you looking for when you're putting on a short put strategy?
Yeah, well, first, so a spread, that limits your risk. So if you were to, people sell naked puts. I've been around too long to sell naked because anything could happen, even in market-wide symbols like SPY. And so, I like the more conservative approach, and the more conservative return on risk approach. And then, so, again, we're looking at, if you read the instructional thing here, it says worst monthly return we're minimizing, worst annual return we're minimizing, and the max drawdown, which is peak to valley. That's what we want to minimize that. So these particular strategies, they may not look like great annual returns from a notional amount, but again, you could look at, if we slide over, we'll start to see things like, so there's the 1.75%, the average daily percent. It's in the market, 99% of the time. Last year, how did it do? The last 5 years, how did it do? But here's how did it do during bull markets. That's when these short put spreads do the best. So that's no surprise there. But the margin returns are quite impressive. I think 30% returns quite good, and that's really how much you need to put up. So that's important. Sharp ratios are okay. Sortino, okay. The volatility is decently low. Max drawdown, 11%. That's, again, not that bad. And then it just goes on and on. The best trade, worst trade, and such. So those are the types of things that I like to look for. And if you don't have any questions on that, Tyler.
Yeah, the margin return versus the notional, it's a pretty big difference, especially in the backtester where we show both of the returns. So the margin return, as you see, 37%, and the notional it's like 1.5 or something like that.
Yeah,
Pretty
1.7
big gap there. Yeah, and so can you explain a little bit about why that gap exists and which of those you want to look at depending on how you're trading?
Yeah, definitely. So the annual return uses the stock price or notional price, as some people say, but it's really the stock price when you open a trade as the denominator. So, SPY is 500 right now or so. So if you make a certain amount, a certain amount of money, then you just divide by the stock price. Whereas the margin return, that's just how much you really have at risk. And so, in this example, when we have a certain delta and where we're selling a certain delta and buying a certain delta, your margin or your risk is just the difference between those strikes. Plus you get a little bit of revenue from selling it. So that's your denominator. So that denominator is much smaller, so your returns become a much larger based on that. So another reason I like to use spreads is because the margin return usually is higher. For example, if you just sold a naked put, then your margin is much higher. So that's how we measure the annual margin versus the annual return that's based on a notional or stock price denominator.
Great. Yeah. So is it fair to say then we use the notional and the backtester to sort of compare backtests like apples to apples across different symbols and strategies, and then we use the margin return on sort of a per strategy basis if you really want to look at how much you're risking and sort of the graph of performance. And we can pull up a graph of performance here.
Yeah.
If you click on one of those.
Yeah. Yeah, definitely. I mean, the annual return is a lot more conservative when you use notional. Often when you're using stock with the strategy, your stock return might be 10%, but your overlay strategy might be a certain percent, but you want to have those in the same terms, so you could add them together and understand what the return is that you're getting from that entire strategy. Whereas on its own, the margin return is really what you're getting based on the risk and the capital at risk. So I like to look at both for those reasons. And if you click on these, as you say, Tyler, you could say what your percent capital is for this particular trade, whether it's compounded or not, what your starting capital is. But so this particular short put spread, it's got a decently high delta and longer term. So this has a very high correlation to the stock price. So the strategy is the orange and the stock return is the blue. So you might say, well, the blue is higher than the orange. Well, also what we're seeing is that the volatility is much less on the orange. So you could see like the drawdown where COVID happened is much less with the selling the out of the money put spread than you saw in the stock. So that's why that Sharp or Sortino might be better on this particular strategy. So this is how this looks. And then the exit return. So I think these are interesting. If it goes against you 75%, it tells you to close it. Or if you have a 75% profit, it wants you to close it as well. Roll into another strategy. And you can see this in the now I'm clicked on the trade log, so you can see all the trades that you did 2023 on, You can see all the years that we had it going for this particular test, and you could see what happened when you got out, what your profit was, and all. So you could see that the profit looks like there's a lot of green here. Is a high profit percentage. You go to the performance metrics and see what your win rate was. So you're in the market 99% of the time, and you won 61, 62%. Almost 2/3 of the time you're winning these trades. So it's a strategy, definitely a bullish strategy to be in. Okay, sharp drawdowns, not that high since you have a stop loss. So I think this is a decently aggressive strategy for the short put spread, Tyler.
Yeah, it's really neat. Can you go back to that backtest real quick and click on it again?
Sure.
If I wanted to see another backtest that was very similar but had a different exit trigger, so if I wanted to test maybe a 50% stop loss or no stop loss instead of the 75, just to see how that worked, we could do that with the find similar.
Right. So if you go to find similar, you could then hold everything constant, like the DTE around 36 days. The strike delta is 33.15. Strike width, if there's anything there, and you could hold all those constant, and then it will then put all these filters in, so you could see all the how all the different ones. So if you recall, we had a 75% stop loss, 75% profit target. Now here's, if you were to get out at 50%, that's in second place. You might say, well, this is higher, but again, we are looking at things like how much movement there is in the particular. Let's see. I think I clicked on one, so I have to go back and click off enter triggers. So and oh yeah, I don't want any of these. So again, if you were to use a slightly different stop loss or a slightly different profit target, I was looking at this one. You might say, well, this is 1.664. How are these sorted? Again, they're sorted by risk, not just total annual return here. So this is good because you could then, I like this feature a lot, because then you could put in, a lot. So you could see if you're overfitting or not with the stop losses. So, do you want a stop loss or do you not want a stop loss? So here's the strategy without a stop loss, 1.75, and then so you could see, okay, what the stop loss then did was minimize the drawdowns more, and so that's why the sort, so the sort, so it's 18% drawdown without stop losses, 11% with. So yeah, so those Tyler, those are the similar back tests for the short put spread. So basically, for SPY at least, when you have something a little bit closer to the money, you want to stay on the exit triggers. Now, if I clear these filters and I add a few, I'll just let it go without any, as you recall that we had some filters for it, so if you, let me clear out. So some of these have entries in a very small amount of trading. So I'm just going to say none. I want to have more time in the market. So there's 98% of time in the market. So one of the things I filtered out was these way out of the money ones, but these actually look now pretty good. This is the number one, selling 23 delta, buying a 4 delta. So with stop losses in there is the favorite for SPY. What I like to do now though is kind of remember what these were and then head over to IWM and see what it looks like over there. So without any ado, so if we go over to IWM, so now we're looking at IWM, and what do you notice? That the IWM doesn't want you to exit. So the exit triggers are much fewer and far between than in SPY. and it's kind of a longer term that IWM likes. So basically what this is saying is for IWM, it's a longer term. So you have a longer term, farther out of the money, wider type of backtest that it's like. Now, if you set some of the filters here and say, well, let's compare apples to apples. Let's do like the 15 to what did I have it at before? Let's just say 60 days. And so then, and we had, I believe we're selling the 60. So we're selling 15 delta to 45 delta. And then, if this were higher too. So now if we filter this down, then we get some more profit taking. Here's interestingly enough, this is a shorter term, more at the money, and they either want to take profits or have a stop loss. That's optimal. So I think what you get from this backtest is, when you step back, is interesting to look at. First of all, for this particular return on risk, if you're really watching, your drawdowns, it wants you to trade farther out of the money, and it'll let it run its course usually, at least in IWM. In SPY, it's closer to the money, but having tighter profit taking and stop losses. So it's pretty interesting. IWM tends to be a higher volatility. Obviously, SPY is looked at the most. A lot of tighter markets. So that could also help with the exit triggers. How's that sound, Tyler?
Yeah, sounds good. I was actually just about to ask before you finish there, like IWM, is there a difference between IWM and SPY, and why you might see this in IWM and not see it in SPY? You said there was some higher volatility on IWM.
Right. So, in this case, we're really trying to manage our risk. We want to, we don't want the drawdowns, because that's what we're sorting on. We don't want bad months. We don't want drawdowns. And we want, a decent return compared to that. And so what's the answer in IWM? That's, much more volatile than SPY. What they're saying is, well, in order to do that, you're going to have to go out of the money more. So, we can take a look at it. So that's, this is the look of something that's, almost a short put that is much farther out of the money. And you could see that the drawdown isn't as great, and then you just make little amounts, and then but you don't participate. So this was a pretty awesome rally that IWM had. Of course, if you're just selling these out of the money put spreads, you're not going to participate as much. But on these drawdowns, you're not going to lose as much generally. So so clearly, 2008, you did just a ton better than the market, but then the market itself caught you, around 2012, and then it's been doing better on an absolute return to own the stock. But again, from a you also want to look at Sharpe ratios. You want to look at annual margin return. So the Sharpe and the Sortino at 65, that's a pretty good Sharpe ratio, meaning the return divided by the volatility is pretty good for that for these measurements, and the volatility is a lot lower than the stock for this, since you're selling it out of the money put spread. And we'll just look at a few here. So you're making $135. You sold at 185 put, bought a 175 put, did that for $1.37, and finished out of the money. So you rode it all the way. Like there's no exits here. So you roll that one all the way. And if you kind of scroll down, you'll see a lot of green. You're going to win. But when you lose, I don't know if there'd be any even losses in 2024. So I'm just scrolling down, looking at these green, and not seeing much loss. Obviously, if we go to different month or different year, you're going to see some red coming in. So so there's one where you got in at 165, and then the stock went down to 146. through there, and so you lost 500 while making 60. So that reward to risk ratio wasn't that good, and you can see here it's about 6 to 1. We can average the reward to risk ratios on this particular strategy. So yeah, I mean, in IWM, I mean, your question is like, why the difference, right? So IWM had a lot more volatility, and so selling the out of the money puts performed a lot better with those drawdowns than we saw in SPY. But I think it's a really interesting comparison to do. So what they're saying is, yeah, with SPY, you want to sell it a little bit meatier, a little shorter term, and beyond the stop losses, which is real interesting. I mean, it's this is a pretty different way to trade SPY than IWM. Just for all the volatility in IWM has really changed how you want to approach trading. Both of these symbols are a lot different, and I've noticed that just trading them. IWM, they seem like they're correlated, but you'll see you'll see a lot of differences when it's a lot more volatile, and it just really whipsaws a lot more in IWM, which is so they're saying, well, in that case, we'll do a slightly longer, slightly more out of the money put spread, and then just hold on, and it tends to come back, and you tend to get some higher price way out of the money put spreads that you could sell in IWM, and then you just again hold on to it. Whereas in SPY, what the backtests are saying, 5 million backtest run in this case, that you could be a little bit more at the money and a little more aggressive on profit taking and stop losses, and that's the way to maximize this particular return on risk that we're looking at here, Tyler.
Yeah, that was a great clarification, sort of, the differences between IWM and SPY. I want to reiterate one of the neat things about our backtester, especially when it comes to a highly volatile environment. So if you click on the backtest again, Matt, and you go to the trade log, I was noticing how a lot of the trades were sort of one after the other. See, it was placed on January 3rd, then the 4th, and then it sort of just happens one after the other. Can you explain why we backtest it this way, and why isn't it just like January 3rd, wait for a month, and then place the trade on, late February or late March?
Yeah, that's a good observation, Tyler. The reason that we're doing it, almost every day is, one, we can, and two, you're not going to trade like that, but it really gives you a better picture, like, because you'll have on these trades all the time. Because what happens if you just go serially, like one in, one out, then close it, one in, one out, what's happening is, if there's a sharp move near the end, it might be so out of the money that it's never going to affect it. Whereas if you were just putting on a trade, then it affects it a lot more. I don't know if that makes sense, but if you put on more trades, you're going to have a much truer backtest than if you only do it just one on, one off, one on, one off. Like, we like to have many on at the same time. We average the returns, and you could get a much better look. I think it's misleading if you're not doing that. I mean, we do it like, we could do 5 days difference, but we like to do it as much as we can, just to show so that you don't have the path dependency if you had on only one trade at a time. So that's a good question.
Yeah, we call it path dependency, right? And so we have blogs and university articles on this as well. But it's a really key component of our backtester. It's what makes our backtester so comprehensive and high quality. And again, it's sort of like our backtester is used for like research, right? Like, we're not saying trade this every single day. That's not really a practical approach, right? But our backtester is used for researching and seeing what strategy outperforms the other. So I would use it as a tool for comparing different backtests and different strategies. And same thing with the graph. You can sort of see how the strategy performs versus the stock. It's not like an exact replica of how, we're saying you're going to do this, so you're going to do this great. It's more for research purposes.
Right. And you wouldn't be trading every day. The commissions and such would be a nightmare to manage. But we could manage it in our backtester, and then you could expect with reasonable a reasonable cadence to put in. You should have trades on if you want to get the returns that are kind of expected in the backtest. You want to space out. You just don't want to like put in one huge trade and not do anything for 50 days or whatever, however many days to expiration. You want to, if you're gonna try to recreate these backtests, you're going to want to be in. You don't have to be in every day, but you're going to want to have to be in if the stock moves precipitously. It changes everything. So you want to have trades on at kind of each level in order to follow this particular strategy.
That's a very important trading tip, Matt. I think a lot of people would benefit from that.
Yeah, so that's about it, Tyler, on the short put spreads. I mean, I think these all these backtests, all these that we have in there, it's a gold mine. I mean, it's really difficult to run all these. We store them all, and you can come in and check them out, and set your filters and try to find the best way that's worked historically. It's not always going to work in the future, but and then you could set up things to trade it, paper trade, and see how they do. So this is a great tool. I've learned a lot from it. It's driven a lot of my trading, and we've talked in other shows about the trade ideas and how it ties in. So the trade ideas tie into the best ones, and then it just gets the best of the best. So that's a real neat tool that we have as well. So that's how I like to use all this information, Tyler.
There's a lot of information in there, Matt. Well, I think we're just about out of time. But if you guys have any questions, you can leave a comment below or email us at support@orats.com. We'll see you guys again next week, and thank you for being on the show.
Thanks, trader.
All opinions expressed by Trader Hub contributors are solely the contributors' opinions and do not reflect the opinions of Trader nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Trader nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Trader Inc. is the parent company of Trader Brokerage Inc. Trader Brokerage Inc. and Trader Inc. are separate entities with their own products and services. Securities products and services are offered through Trader Brokerage Inc. Trader Brokerage Inc. is an independent subsidiary of Trader Inc., all rights reserved, member FINRA SIPC.